Are you ready to navigate the ever-evolving world of commercial real estate? With market dynamics constantly shifting, it's crucial to stay ahead of the curve. Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. In today's episode, we're diving into the top 5 commercial real estate trends that are reshaping the industry. As highlighted by James Nelson, a contributor at Forbes and an investment sales broker based in New York City, these trends are pivotal for investors looking to maximize returns and capitalize on emerging opportunities. First up is the trend of office to residential conversions. As office vacancies rise and cities face a shortage of residential units, converting outdated office buildings into apartments or condos is becoming a creative solution. This approach not only addresses housing demand, but also helps stabilize the office sector by reducing available office space. However, these conversions come with challenges like zoning restrictions and construction costs, so having the right team is essential. Next, we have the rise of specialty assets. Beyond traditional asset classes, healthcare facilities, student housing, senior living, cold storage, and life sciences labs are gaining traction. These assets align with demographic and economic trends, such as an aging population driving demand for senior housing and healthcare facilities, and the e-commerce boom increasing the need for cold storage. For investors looking to diversify, this segment presents intriguing opportunities. The third trend is the surge in demand for data centers. With the expansion of digital infrastructure, artificial intelligence adoption, and cloud computing, there is a race for suitable land for data centers. Investors need to consider factors like access to power supply and appropriate locations. The barriers to entry are high, making it crucial to collaborate with partners specializing in this sector. Another significant trend is the rise of private buyers and corporate end users in transactions. Unlike institutions, private investors and companies can move quickly to seize opportunities, especially in markets like New York and San Francisco, where prices have reset. Having access to capital and a willingness to explore unconventional opportunities can give you a competitive edge. Finally, diversification across markets is becoming more important. Investors are no longer focusing solely on a single market, but are exploring opportunities nationwide in cities like Dallas, Charlotte, and Atlanta. This approach doesn't mean chasing every emerging city, but rather being open to trends beyond your immediate area. Diversification across markets and asset classes can provide stability and uncover undervalued opportunities. In summary, staying flexible, watching for signals, and being willing to explore where others aren't yet focused can position you for long-term success in the commercial real estate landscape. That's all for this segment. Stay tuned as we explore more exciting developments in the world of commercial real estate. A New Jersey-based real estate firm recently made headlines with a significant acquisition in Naperville. The Solomon Organization, headquartered in Summit, New Jersey, purchased the 1598 apartments, marking the highest-priced suburban apartment sale of 2025. This transaction, valued at $136 million, was recorded in DuPage County property records, as reported by Crain's Chicago Business. The 640-unit rental complex was acquired from FPA Multifamily, an investor known for frequent buying and selling of apartment buildings in the Chicago area. This sale was notable not only for its price, but also because it represents a substantial increase from the $98.5 million FPA Multifamily paid for the property back in 2017. According to the CoStar Group, the sale price reflects an increase of about 38%, which showcases a significant return on investment for FPA. In the broader context, the Naperville apartment deal is the priciest suburban Chicago apartment trade since December of last year, when Hines, a Houston-based real estate firm, acquired the E2 apartments in downtown Evanston for $148 million. The Solomon Organization's acquisition follows another major sale earlier in August, where TLC Management acquired a property in Vernon Hills for $100 million. The demand for apartment properties around Chicago remains strong, driven by limited new construction and robust rental demand. The median net rent in suburban Chicago was $2.18 per square foot in the second quarter, up 4.1% from the same period in 2024, according to Integra Realty Resources. This trend highlights the attractiveness of the Chicago suburban apartment market for investors. The newly acquired 1598 apartments, located at 1598 Fairway Drive, were built in 1984 and are approximately 93% occupied. The average effective rent is $1,879 per month, or $2.11 per square foot. Solomon Organization financed this acquisition with a $90.8 million Fannie Mae loan arranged by real estate services firm Berkadia. This acquisition is part of Solomon Organization's broader multifamily portfolio, which spans about 21,000 units across 10 states. Since 2015, the firm has completed transactions totaling over $4 billion, underscoring their significant presence in the multifamily real estate market. In comparison, the Canadian market, particularly in areas like Kitchener-Waterloo and Cambridge, Ontario, is experiencing similar trends in multifamily investments. With limited land for new developments and a steady influx of residents, these regions are seeing increased interest from investors. Cross-border insights suggest that the demand for multifamily properties remains robust, aligning with the trends observed in the United States, as investors seek stable returns amidst fluctuating markets. A fully leased office campus near the King of Prussia Mall has been sold for $68 million. This transaction, covered by Paul Schwedelson from the Philadelphia Business Journal, highlights a unique occurrence in the suburban office market, given that many similar properties have been trading at significant discounts recently. The property, located at 1170 to 90 Devon Park Drive in Wayne, is fully leased by USLI, a notable tenant in the area. This sale stands out as it goes against the trend of steeply discounted suburban office sales. The transaction reflects a modest increase from its previous sale price, signaling a potential shift in market confidence for well-leased suburban office spaces. The King of Prussia area, known for its strategic location and proximity to Philadelphia, remains a desirable area for businesses, contributing to the property's appeal. In contrast, the office market in Kitchener-Waterloo and Cambridge, Ontario, is experiencing a different dynamic. Here, the focus has shifted significantly towards multifamily developments, driven by a growing population and a strong demand for residential units. With limited land available for new office developments, the emphasis has been on repurposing existing office spaces for residential use, aligning with the trend of office-to-residential conversions observed in other major cities. This cross-border comparison highlights the varying approaches to commercial real estate investments in different regions. While the King of Prussia sale suggests a potential rebound in suburban office investments, the Canadian market's shift towards multifamily developments underscores the importance of adapting strategies to local market conditions. Investors looking to diversify their portfolios can benefit from understanding these regional differences and exploring opportunities in both the office and multifamily sectors. Stonepeak's recent acquisition of 2 logistics assets in Fort Worth, Texas, totaling 1.1 million square feet in the Alliance submarket, underscores a pivotal shift in industrial real estate investment strategies. This move is part of a broader 7.7 million square foot portfolio expansion in Dallas-Fort Worth since April 2024, reflecting a growing industry focus on high-growth logistics hubs anchored by critical infrastructure. The Alliance submarket, with its proximity to the BNSF Intermodal Terminal, Fort Worth Alliance Cargo Airport, and the I-35 North American Free Trade Agreement Highway, epitomizes the demand for real estate that aligns with supply chain resilience and e-commerce-driven last-mile delivery needs. The Dallas-Fort Worth region, home to over 8 million residents, is projected to grow at 3 times the national average through 2030, driven by its strategic location as a crossroads for North American trade. This demographic and economic tailwind has made Dallas-Fort Worth a magnet for institutional capital. In the second quarter of 2025 alone, the market recorded $1.5 billion in investment sales and a 35.8% quarterly increase in leasing activity, with vacancy rates dropping to 9.1%. Such metrics highlight the submarket's ability to absorb demand, even amid a national slowdown in speculative construction. The broader industrial real estate sector is recalibrating to prioritize assets with infrastructure-like qualities. Investors are no longer chasing speculative bulk logistics space. they're seeking stabilized core assets in constrained submarkets with embedded demand drivers. This shift is evident in Dallas-Fort Worth, where developers are pivoting to build-to-suit projects and smaller, flexible facilities to meet tenant needs. For example, Amazon's 1.7 million square foot warehouse in South Fort Worth and DICK's Sporting Goods' 800,000 square foot distribution center exemplify the trend toward customized, supply chain anchored real estate. The strategic rationale for Stonepeak's acquisition is further reinforced by macroeconomic forces. Reshoring and nearshoring initiatives, accelerated by trade policy shifts and geopolitical risks, are driving demand for domestic logistics infrastructure. A 2025 report notes that 65% of supply chain executives plan to source key items from regional suppliers by 2026, up from 38% today. Dallas-Fort Worth's role as a nexus for United States-Mexico trade, bolstered by its proximity to border crossings and the I-35 corridor, positions it as a linchpin for this regionalization trend. Stonepeak's focus on transport-anchored real estate aligns with the sector's evolving priorities. The firm's portfolio in Dallas-Fort Worth, Houston, Jacksonville, and Chicago now spans 7.7 million square feet of assets with direct access to rail, air, and highway networks. This strategy mirrors industry-wide moves toward mission-critical locations, where durable cash flows and supply chain indispensability mitigate risks from economic cycles. The Dallas-Fort Worth market's appeal is also amplified by its infrastructure readiness. Public investments in projects like the I-35 North Express expansion and State Highway 46 widening are unlocking development potential, while the region's labor pool, growing by 120,000 residents annually, ensures long-term demand for logistics facilities. As one industry analyst observes, Dallas-Fort Worth's combination of population growth, business-friendly policies, and multimodal connectivity makes it a blueprint for the next generation of logistics hubs. In conclusion, Stonepeak's acquisition in Fort Worth is not an isolated transaction, but a symptom of a larger industry pivot. Investors are increasingly prioritizing high-growth logistics hubs with infrastructure resilience, demographic momentum, and strategic trade connectivity. In 2025, the commercial real estate landscape is experiencing a transformative shift, driven by non-traditional financing tools and private equity innovation. As traditional banks tighten lending standards and interest rates remain elevated, private equity firms and specialty finance providers are stepping in to fill capital gaps. They're leveraging mezzanine loans, non-bank partnerships, and creative capital stack structures to unlock value in a volatile market. This trend is reshaping commercial real estate investment strategies and delivering robust returns for investors who navigate the evolving landscape with agility. Mezzanine financing has emerged as a cornerstone of private equity real estate strategies. By offering a hybrid structure that combines high-yield debt with equity upside, mezzanine loans enable developers to access capital without diluting ownership excessively. For instance, PGIM Real Estate recently provided a $24 million mezzanine loan for a 310-unit multifamily development in Miami, Florida, in partnership with Clearline Real Estate and American Landmark. This transaction highlights how mezzanine financing can push total loan-to-cost ratios to 85 to 90%, compared to the 65 to 75% cap of traditional mortgages. The appeal of mezzanine loans lies in their flexibility. Lenders typically charge interest rates between 12 to 18% and may include equity warrants or profit participation clauses, offering additional returns if the asset appreciates. In 2025, the private credit market, projected to grow from $1.5 trillion in 2024 to $2.6 trillion by 2029, is further amplifying the role of mezzanine financing, particularly in sectors like logistics and healthcare. Non-bank lenders have become critical players in commercial real estate financing, especially as traditional banks face stricter capital requirements under Basel III rules. These lenders offer tailored solutions, including bridge loans and private debt, to support projects in high-growth markets. For instance, in early 2025, private lenders originated $4.43 billion in short-term commercial real estate loans, surpassing the previous year's total. The rise of non-bank partnerships is also driven by the $2 trillion private credit market, which now competes with traditional banks for commercial real estate assets. Nearly $5 to $6 trillion in commercial real estate loans could shift to non-banks over the next decade, according to industry estimates. This shift is particularly evident in the industrial sector, where e-commerce-driven demand for logistics hubs has spurred a surge in non-bank financing. Warehouse rents, for example, rose to $10.13 per square foot in the fourth quarter of 2024, a 61% increase since 2019. The financial performance of non-traditional financing tools is underscored by real-world examples. Clarion Partners, Real Estate Income Fund Incorporated, provided a mezzanine loan for the New York City-based Biltmore apartment complex, enabling a joint venture to refinance existing debt and invest in property upgrades. Such strategies have delivered double-digit returns for investors, with mezzanine debt often outperforming senior loans due to its equity participation features. Moreover, the mid-market has become a focal point for private equity firms seeking resilience amid macroeconomic uncertainty. Limited partners are increasingly allocating capital to mid-market funds, which offer alpha generation potential during economic cycles. For example, the New York State Teachers Retirement System and the California Public Employees Retirement System have expanded their mid-market real estate exposure in 2025. Despite the optimism, challenges persist. Interest rate uncertainty and cybersecurity risks remain top concerns for commercial real estate investors. Additionally, liquidity bottlenecks have forced limited partners to prioritize exits, even at discounts to net asset value. However, the soft economic landing anticipated in 2025 and potential rate cuts by central banks could alleviate some pressures, improving financing conditions and tenant demand. In conclusion, non-traditional financing is redefining the commercial real estate landscape, with private equity and specialty finance tools at the forefront. By leveraging mezzanine loans, non-bank partnerships, and innovative capital structures, investors are navigating a complex market while capturing high returns. As the sector adapts to macroeconomic shifts and technological advancements, those who embrace these trends will be best positioned to capitalize on the opportunities ahead. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.